Hello everybody, my name's Dougie Payton. I'm a partner in Condy's Chartered Accountants, and I'm here with Scott Halsey, who's our tax strategist in the firm. We've heard a lot in the press about this new 50% tax regime. Scott, what's it all about? Who's at risk here?
Well, it says people that have a taxable income in excess of £150,000 with effect from the start of the 2010-2011 tax year. So there'll be people like successful self-employed, people that take £150,000 in, plus in salary out of the company, out of their own company. So quite a few people with sort of medium-sized businesses, I think, and certainly in the Scottish sector, will be affected by this charge. I mean, the charge was going to be 45%, you'll remember, and I think it was a year hence from when it's actually going to start now. So it's been brought forward, and it's been combined with changes to the higher rate tax relief on pension contributions regime. So the effect can be a marginal rate of 60-70% in some cases.
So that's a lot of extra tax compared to what people are paying just now, potentially.
Well, yeah, I mean, it's a funny thing that the tax regimes, the 70% seems to be a number that recurs. It can recur for you can have a 70% tax charge for people that earn tax credits, below say £20,000 per annum, and now you've got a 70% potential charge, and people that earn more than £150,000 per annum, and everyone else in between, it's let's say 35 to 40% tax, plus again national insurance at 1% over £41,400. So it's quite a change there. It's quite a disincentive to take money from your company, or in fact just earn that through your self-employed business. It may in some cases even be better spending it on something else rather than incur this additional charge.
So in the same vein then, what can people do to mitigate this tax charge? Well,
we were talking slightly before this. I mean, I'm against tax-driven incorporation, but incorporating your business can be a successful way of avoiding the higher rates of personal tax, because the highest rate of corporation tax is 28%. But that's only if you keep the money in the company. You would pay an excessive amount of personal tax were you to take it out under the increased tax personal tax regime after 2010-2011. It's true to say, but incorporating your business can be a successful way of just retaining earnings that you don't need to spend anyway. So if you can afford to incorporate, and certainly that's a way of saving tax at the higher rates. Although, as I said, it's not something that's to be done solely for that purpose.
So other than incorporation then, are there other things that people can be doing to try and lessen their overall tax bill?
Well, I mean, I think what we've got to try and do is we've got to try and maybe convert some of the income you have into capital. I mean, there are several ways you can do that. I mean, the tax-driven incorporation idea is certainly a way of transferring your income into capital, although there is anti-avoidance legislation there to stop that happening. So again, I'd reiterate that incorporating it can seem like a good idea, but if it's only done for tax reasons, it's a bad one. You could, for instance, take out a single premium life insurance policy with an investment base. You can take out 5% of what you've invested in capital terms every year, and that's not income. It's not taxable income. It's not taxable gains, as long as it's only 5%. So if you put, let's say, £500,000 into a single premium life insurance policy, you can take out £25,000 per annum for the next 20 years and bear no more tax on it. So it can be a way of reducing your tax liabilities that way.
You mentioned there that capital income was potentially more favourable than revenue income. Can you tell us a bit more about that?
Well, the capital gains tax regime changed, it must be a year and a half ago now. There's a flat rate of 18% chargeable, whatever your income levels are. So, there are simple ways of reducing your tax liability. I mean, the first £10,000 of any capital gains in the year, will not be subject to capital gains tax even. And there are certain types of capital investment that attract what's known as entrepreneurs relief and give you a 10% effective rate. So there, if you think about it, £10,000 a year between a married couple, that's £20,000. For 5 years, there's £100,000 without really sort of trying to do anything particularly risky or something that too complicated.
And what about these more complex tax planning products? Can you tell us anything about some of those?
Well, there are. If in terms of risk, your least risky would be asking your own personal company to make a pension contribution on your behalf, and the reason for that is that obviously a pension is a tax deferral mechanism, and the government recognise that, and although they've reduced the amount of personal relief, they haven't stopped companies making contributions on their employees, their owner directors' behalves. So that's on that side of things. That's the sort of least risky side of things. There are other riskier methods of removing money from the balance sheet and not paying income tax. Off the top of my head, something like an employee benefit trust is something that can be used as long as it's structured carefully to remove cash from your company to be put into trust and then lent to you at a commercial rate, let's say, until you pay it back when you retire and cash in your 25% tax-free lump sum. So although the corporation tax deduction's not there in the company, you're getting the cash to use until such time as you're able to pay it back. So the revenue, they don't like that style of things. The risk is that the revenue give you increased attention. It could be that, as I've talked in another podcast, that they decide you're a risky taxpayer and decide that they're going to come and visit you more often. And the ultimate blow could be that you end up paying more tax and on top of that interest at the end of the day. There are far riskier products out there. Again, it's something that I would suggest I would take it by situation. I certainly I'm aware that there are things out there that promise to reduce your tax at a stroke, and I always like to discuss that personally with people. So if anyone wants to come in and certainly talk about these type of ideas, then just give me a call. I'll be happy to see you whenever.
Okay, so a lot of scope then for tax planning, but it's got to be done properly, done carefully, properly thought out.
Yeah, I'm not a fantastic fan of off-the-shelf tax avoidance products, and the reason for it is that I think it's a bespoke thing, and certainly there are only certain partners I would trust to do it properly. The paperwork is very often the deal breaker in these things, and it has to be done properly to actually achieve the objective. Thank you for that.
And as Scott said, if anybody would like further information on anything that we've talked about in this podcast, please don't hesitate to give us a call, send us an email. Please do get in touch.